Welcome guys to a new video. In this one we're gonna talk about a very important subject, which is liquidity. How to spot liquidity to determine the direction of the market. I'm gonna show you the definition of liquidity, the types of liquidity, and then I'm gonna show you visuals and live examples. I'm gonna show you live examples from previous week and how I was able to predict the move of the markets entirely based on liquidity. So take notes, proceed with open mind and focus, and stick to the end of this video to know exactly how to apply liquidity to determine the direction of the market. Now, basically there is two types of liquidity. We have high resistance liquidity and we have low resistance liquidity. So in this video we're gonna talk about, first of all, the definition of high resistance liquidity and low resistance liquidity. So what makes a liquidity high resistance and what makes it low resistance, and how to trade it. The next thing is I'm gonna show you visual representations of them. I'm gonna give you like a template to navigate the market with it. And the third thing, I'm gonna show you how to use it to take trades. So how to base your trades on these two concepts. And at the end, I'm gonna show you live examples from this previous week. So examples that I have predicted. I took a screenshot before and after. I'm gonna walk through the narrative and show you exactly how to apply today's lesson in live markets. So without any further ado, let's just get started. So first of all, let's define a low resistance. What is low resistance liquidity? So low resistance liquidity occurs when the market is creating failed swings. Now, what is a failed swing? A failed swing is when a swing high, for example, fails to run on a previous swing high, or when a swing low fails to run on a previous swing low. Now, how does that look like in the market? Let's start with a swing high fails to run on a previous swing high. So it is basically like this. So you can see that this swing right here, this is swing high, failed to take this swing. So we have liquidity here and here. So we are engineering liquidity. This swing couldn't take liquidity from here. So this is engineering. The retail traders will see this as a trend line as the market is bearish, but smart money is generating liquidity, engineering liquidity to be taken next. So this is low resistance liquidity run. Let's move on to high resistance liquidity. High resistance liquidity. High resistance liquidity occurs when a swing high runs on a previous swing high and rejects, causing a break of structure, or when a swing low runs on a previous swing low and rejects. So it will run through that swing and then immediately reject on the other direction, causing a break of structure. Now, how does that look like in the market? It will be something like this. So maybe you have like this. So this swing right here run on this previous swing and then rejects immediately. So this one right here will become high resistance liquidity. I'm gonna show you the logic behind it on live examples, so don't rush. Now let's see how it looks like both high resistance and low resistance in the market and how you can capitalize on these moves. So in this example, you can identify low resistance liquidity and high resistance liquidity. You can see here that the market on the sell side of the curve is creating low resistance liquidity run. So you can see here the market makers are engineering liquidity, are engineering based on failed swings. So the market after reaching a discount area right here, it will go through this liquidity with ease. All right, guys. So you can see that we are engineering low resistance liquidity right here, and after this you can see that we have a high resistance liquidity. So this swing right here run through this alt swing and then immediately rejects, causing a break of structure, retracement here, and then a little bit of a move, then creating another high resistance liquidity. High resistance liquidity meaning the market would struggle to go here. So the market again here, after creating this high resistance liquidity, the market will struggle to come back here. Why? What is the logic behind it? Because we have already taken liquidity here. We have already taken liquidity here. Also, we have already taken liquidity, plus we hit a discount array. A discount array is basically an order block, fair value gap. It can be a breaker, mitigation block, rejection block, anything. A discount higher time frame array. So the market, after creating this high resistance, the logic behind it, because we have already taken liquidity, we have already stopped, the market makers already stopped the retail traders. So they don't want to come back here and give them an opportunity to participate in this move right here. But and why the market was explosive here? Because you can see that there is liquidity here that has never been touched. So the market makers on this move right here, if you put a vertical right here, you can see from this side you want to see high resistance liquidity on this side. So if you want to take buys, then on this side you want to see high resistance liquidity. On the other side you want to see low resistance liquidity run, because the market will just go through it and have absolutely no barriers to reject from. So you can see that there is liquidity here, 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 here. The retail traders are trailing their stops all the way to here. So that's why you want to see low resistance liquidity on the direction you want to take a trade from. Now let's see a bearish example. Now let's see the example here. So you can see on the buy side of the curve, we were creating low resistance liquidity. You can see from here. Here also we have failed swings all the way. So failed swings will create our low resistance. All right, guys. These failed swings will after hitting a premium array or after taking a higher time frame objective, then they will act like a magnet to price. It will act like a magnet to price. Price will easily run through them. Now we can see that we are creating high low resistance liquidity here, hitting a premium array, which also can again, it can be order block, fair value gap, breaker. Then we have a high resistance liquidity here. We have this swing high, run through this swing high, and then immediately rejects, causing a break of structure. Then retracing a little bit. All right, another high resistance, and then moving down, targeting this low resistance liquidity right here. All right, guys. Now let's stop with this and let's go to the examples. And you will learn how to apply these concepts live. Let's go through the first example right here. You can see on here, after hitting this fair value gap right here, I believe this was a 4 hour fair value gap, I don't recall. you can see that we were creating a low resistance liquidity. So you can see that this failed swings right here, we have liquidity above them. And on here, after hitting a higher time frame period rate, you can see that we are creating a low resistance. You can see that we are creating high resistance. So after taking this swing right here, we can see that we have immediately reject. So our next target would be this engineered liquidity right here, and you can see right here, you can see this explosive move. The market didn't have any problem to go through them. You can see that a smooth move to the upside. Let's go to another example, and this is eurusd on the 50-minute chart. You can see that the market we have here low resistance liquidity, so we have swings right here. You can see a swing right here, a failed swing, failed swing. Now this might be this doesn't look like a swing, all right, because the swing is identified by a 3 candle formation, but we are on the 15-minute time frame. If we go to the 5-minute time frame or the 3-minute time frame, so these candles here represent a swing. So we have failed swings right here. We have here, then we have a high resistance liquidity here. Why? Because we have taken this previous swing low and then immediately reject. So our next target is this low resistance liquidity, and we have this fair value gap right here. And you can see the market come back one more time, creating high resistance liquidity and then explosive move to the upside. Let's go to another example, and this is a beautiful example. We have the market is creating a failed swing on the buy side of the curve. You can see that we have a failed swing here, another one here, and another one here. All right, the market here creating a high resistance liquidity, taking this swing and then immediately rejects, retracing to a fair value gap, creating another high resistance liquidity. And this is what you want to see. This is high resistance. You want to see high resistance. If the market, for example, create this swing, couldn't run through this swing, then we might go another round to take liquidity and then move down. But you can see that we have already taken liquidity here, and after you can see that the market exploded to the downside, taking all this liquidity from here. Let's go to another example, and this is another beautiful example from last week. You can see that the market is engineering liquidity on the buy side of the curve. You can see that this failed swings right here, so it's clean. Liquidity is all around the place here, running through this previous swing, rejecting, causing a market structure shift. We have another high resistance liquidity run, and after that we can see beautiful move to the downside. You can see that, for example, you can see that the move here is the price is struggling to come here, but when creating high resistance liquidity and we have a target which is low resistance liquidity, you can see that the market immediately run through them. Another example here, you can see that we are creating low resistance liquidity here. See, we have this failed swing, another failed swing out here, another failed swing, another failed swing. Now on the opposite side, on the buy side, you can see that we are creating high resistance liquidity. For example, we have run through this previous swing low and then immediately reject, causing a market structure. You can see here market structure shift, and you see this move right here, explosive move through this this low resistance. Another one here, this is from Bitcoin. This is I believe from 2 days ago. We are basically creating low resistance liquidity on the opposite side, and we have a high resistance here. You can see that we run through this old lows from here and then reject, and as you can see, the market exploded to the upside. This is also from the US dollar index. You can see that the market is creating low resistance liquidity from this failed swings right here, and continuously creating high resistance liquidity from here. You can see that we are continuously taking liquidity from the sell side. What happens next? Market run to this low resistance liquidity and arriving to this fair value gap right here. So I believe we have reached the end of this video. I hope you found it helpful. If you have any questions, don't hesitate to DM me on my Twitter account or leave a comment down below, and I'll answer you as soon as I can. Happy trading and good luck.